Hello students. Today we'll practice the development of the project interactions. We've learned how to evaluate the project with the 4 investment criteria: NPV, IRR, PI, and discounted payback period with this. But we have some problems when we make a decision with some specific, the unique project. So problem 1 is the investment timing. When would be the best investment timing? Today or in a year? So this case is you may purchase a computer anytime within the next 5 years. The computer will save your company money only for the year when you purchase and the cost of computers continues to decline. If your cost of capital is 10%, and then given the data listed below, when should you purchase the computer? So we have cost of capital 10% for 5 years. So the company will save your money only for that year. That's the point. So when should be purchased? The savings is the cash in and the cost cash out. So we need to calculate first the benefit from this purchase by just adding this plus and minus. Then we have the benefit at purchase. Then which one is the largest one? Okay, 39 at year 5. So you may make a decision. We have to purchase the computer year 5. But this 39, 37, 34, 30, 25, 20 has different value because we should consider as a present value discounted by this 10%. So the present value, when we compare the value in a different timing, we should calculate the present value. Okay, so 20, and this should be 25 divided by 1 plus. Now the 10% I want to fix function f, and to the power of year 1. So 25 in a year is the same as $22. So again, the comparison, the time you compare those future cash flow should be the same time, at the same time, right? So we compare those value at the present time. Now, which one is the largest one? Right, this $34 in year 3 has the present value benefit 25.54. So the best investment timing year 3. If you just pass and then let's just calculate. Let's calculate the present value at the end of year 2. Then now this 37 also calculated by 10% to the power of 1. So still lower than the 34. Okay. The next problem, the choice of between the long and short-lived equipment. Okay, that's the important point. We are using the lowest annual cost, which is the concept of equivalent annual cost, because we want to compare 2 project that has different maturity, different time frame. So given the following cost of operating 2 machines, and then we have the same 6% cost of capital, we need to select not the lowest NPV for the perspective the cost, but the lowest cost using the equivalent annual cost method. Okay, then how to do it? We use the NPV function with the rate. And let's drag this whole number. Let's drag all this number and plus. Okay, we have something wrong there. It should be comma. Okay, 25.69 is the present value of cost of a machine X. And machine Y, how to calculate? It has the different the project year. Also 6%, comma, from year 1 and 2, and plus this money is not going to be added into this NPV calculation again. Otherwise, it considers year 1. So $21 cost. NPV is $21. So that we definitely choose the lowest cost Y. But based on the equivalent annual cost concept, we can consider this machine Y record year from the year 3 once again, over and over and over again, recurring cost starting from year 3, spending $10, next year $6, so that we can compare the machine X and Y fairly, right? In order to do so, we need to calculate what is the payment of equivalent annual cost. What is the annual cost if we stretch these numbers, different amount of numbers, into forever, or we can just the separate in an annual payment. So in this case, we put the 10%, and then MPR. In this case, this number is made by 3 years, right? The 3 years. So we put the 3 years. And then PMT is what we want to know. And then the present value, let's say the present value is 25.69, and then future value is 0. Then this PMT is calculated. Just put all this number. Then we got the 10, oh, sorry, this rate should be 6%. So $9.61 is annual cost. Again, this $15 is also cost, $4. How much would be the annual cost considering all these numbers? So this 9.61 should be allocated here and here and here and every year, right? So the annual cost of machine X, the equivalent annual cost is 9.61. Then, what about a machine Y that has a life 2 years? So we put 2 year, question mark, and the present value should be this, then 0. So this annual payment mechanisms shows 11.45. So we realized that, oh, this machine Y cost spent from year 1 today spend the $11.45 every year. Okay, so we need to consider like this. Okay, then let's move on to the exercise number 2, choosing highest annual cash flows of a project. Okay, also this project A and B has different lifetime, so we need to calculate this. Oh, by the way, we put here machine X was answer. NPV of the project, we need to calculate first 9%, then drag 4 years, plus beginning, and then 2.82 is the NPV of the project A, also NPV, the rate, then the year 2.78. So which one is the bigger, right? The project A. So let's make sure that if the project A produces annual equivalent annual annuity, the larger annuity as well. So the rate 9%, and then number of period, year 4. Again, we allocate this number to the year 1, 2, 3, and 4 once again. Okay, so this NPV is 0. So we realize that the annual benefit from year 1 is 9%, 0.87. Then what about this? The project B? Project B has the project year 3, and then the present value is 2.78. Then the PMT is calculated by PMT 9%, 3 year. And then we realize that this project B, even though the NPV of project is the project A, NPV of project B is lower than project A, considering the annual, the equivalent annual, the annuity, the project B is greater than the project A, the 1.1, because we assume that this project B recurs after year 3 over and over again. So project A also recurs over and over again. So we want to recast this money with the same the annuity, 0.87 or $1.1 every year, so that we can get this number. Okay. Problem number 3. You want to replace an old machine, calculate present value of operating cost. You are operating an old machine that will last 2 more years before it gives up the ghost. It costs $12,000 per year to operate. You can replace it, and now with a new machine that costs $25,000, but is much more efficient, only $8,000 per year in operating cost. Now, it will last for 5 years. Should we replace the machine now or stick with it for a while longer? The opportunity cost of capital is 6%. Okay, so let's just convert this number given into this table. So in 1,000 new machine, how much was the new machine investment? 25,000. And then after that, we have to spend $8,000. So new machine require $8,000 every year. But old machine at this moment don't have to pay anything, but we have to spend the operating cost, 12. We want to avoid this $12,000 the operating cost every year from old machine by replacing with this new machine. But you have to spend $25,000 for the machine cost, and that operating cost that you want to decrease lower than this $12,000. That's the point. Now let's calculate the NPV then. NPV 6% from year 1 to year 5. That's 25. So 58.7 is NPV, the cost. And then it's easy. Again, 6% times year 1 and 2. Plus, we don't have any number, so you can just ignore. So $22. Why it shows here? Okay. So $22,000 is the NPV cost. But if we use this number as an NPV of the total cost, it's not compatible because the new machine has different lifespan, right? So we need to recalculate the new machines, the equivalent annual cost. So 6, the 5 year, and then present value. I want to put present value 58, and then fair value. So what would be the cost, annual cost from this new machine, assuming that we recur this new investment after year 5 over and over again? So let's calculate PMT. So $13, $13,000 is the annual cost. If we recast this $58,000 cost throughout the year 1, 2, 3, 4, 5, okay? Then next is the rate, same 6. And then year 2, that is what we want to know. Then present value 22. So let's calculate. PMT payment, annual payment 6% to 22, 0. So okay, we got the $12,000 is annual cost. So we don't have to replace this machine because the old machine, oh, it just shows only $12,000 annual equivalent cost. But the new cost, machine cost is $13,930. $930. So it's not necessary to replace. Okay, so answer is not. So I want to show this concept of equivalent annual cost once again. That means that we spend this money. We have to spend from year 1, year 2. Once we recast this money like this, and then for 2 years, only $12,000. Okay, let me just show you in parentheses as well, and so that you can compare clearly. Okay, again, the point of this annual equivalent, the equivalent annual cost concept is that once you get the NPV, this NPV does not considering the different time, the useful life of the machine. So in order to compare the two alternatives, we need to get the equivalent annual cost, where we got what would be the annual cost every year. We recast this older cost into this time frame every year so that we can compare clearly. Again, the equivalent annual cost consider recording every year. That means that every year like this, the same amount forever, assuming that we use this machine every year, record every year. So that's it. See you in the next video clip. Bye bye.